Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, and regulatory landscape and capital markets. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq market site, we have Joe Cavatoni, market strategist North America at the World Gold Council, Robert Minter, director of investment strategy of ETFs at Aberdeen Investments, as well as Thomas Vogt. He is head of mining North America at BCG. We're here to discuss why the strength in gold and demand for critical minerals adds a new dimension to the precious metals sector. It is great to have all of you with us. Welcome to Trade Talks. Joe, great to see you as always. And the demand remains robust. The tailwinds for gold still exist, despite it being a GLD up nearly 27%.
That's right. Gold year to date up nearly 30% as a precious metal. The demand trends continue to signal investment. Central banks continuing to be the large consumers that are actually pushing those prices higher. Interestingly enough, gold in its capacity in the industry and technological use, kind of a flat market, but encouraging, because usually when we have high prices, that's an area where we see gold substituted out. And again, the weak spot has been jewelry, which is really a traditional consumer spending area, not a big surprise. China, India, even the US, all showing signs of weakness in the jewelry space. But at the heart of it all, complete risk and uncertainty in terms of markets. Obviously with the new administration, the policies which we've talked to before, giving us a really, really challenging environment to try and judge how risk assets are going to perform. And the role that gold's playing in diversifying risk portfolios is increasing. Consumption at ETFs is picking up, et cetera. But also, the future state of what the economies are going to look like and what these trade talks are going to look like with respect to the dollar-based assets. And Rob, you and I, we were all talking about this earlier. Lots to unpack there and really unclear.
Yeah, so let's talk about fiscal and monetary stimulus for a moment here, Robert, because that's one of the two key factors in terms of what's been driving gold for the past 10 years.
Absolutely. Every problem is solved with more fiscal and monetary stimulus, and it has an effect. And we looked at some data of the total amount of U.S. debt outstanding since 1993 and the gold price since 1993. Roughly, both are up 900%. That's not a coincidence in our view that the continual issuance of debt has devalued, in a way, the U.S. dollar and helped to inflate the relative value of gold.
Yeah. Thomas, the rising tide of strong gold prices, is that lifting the metal space in general?
Yeah, absolutely. It's been incredibly good for the sector overall. Gold stocks have performed very, very strongly over the last 5 and 10 years. What's really interesting, though, is amongst those, some have really outperformed their peers. So at BCG, we think quite deeply about what drives value creation in mining and what management teams can do to change that answer. A bit of our research has found that the top performers in mining overall tend to grow their production and their revenues faster than their peers. They do so while growing margins about 25% faster than peers. They're about 50% more likely to be buyers than sellers of assets. And really interestingly, they tend to invest programmatically through the price cycle, both organic capital projects as well as mergers and acquisitions.
How are emerging technologies such as AI impacting the mining space?
I think it's a really critical time right now, because while prices are high, this is actually when productivity becomes really key to keep front of mind. Costs in mining tend to rise over the long term as gold deposits, grades tend to decline over time, the amount of waste to ore that gets moved over time increases, and it gets harder and harder to find new deposits as well. So productivity remains an absolutely essential ingredient. There's a lot of hype around AI, but actually some of it we think is quite justified. We're seeing leading players investing in things like mine-to-mill integration, recovery optimization in mills, so really squeezing the most out of the ore that they can, and really truly getting to integrated planning between the upstream and the downstream.
I mean, Joe, part of the allure to AI is to improve operational efficiency regardless of what sector you're in. I mean, do you see that happening in the gold space?
Oh, I definitely think it's happening in the gold space. And ironically, it's AI and that technological requirement and gold's role in that tech that's keeping it at the heart of it. And I think that it actually seems to be price inelastic. It doesn't seem to be impacting the need and interest and the capacity for gold to fit into the AI space. But just thinking about the cycle that you're talking about in terms of investors moving into metals throughout these price cycles, I think that what's been fascinating for us to watch closely, and you talked a little bit about it, is that central banking community that's actually been at the table for near record or record years for the last 3, and what looks like it could be the pace to get to that again in 2025. Now, we just released today our annual central bank survey results around their interest in gold as a reserve asset. Nearly every one of those central banks surveyed has said they expect gold to continue to be a consumption asset at the central banks as they grow their reserves. Nearly half are going to be adding to their portfolios. And it's really fascinating to see that it's their concerns around inflation, their concerns around global rates, and their concerns around diversification. And so it's the dollar, which is going to diminish over the next 5 years, something we had seen in previous results and continues to grow. A little less interest in losing interest in the euro, but the dollar's definitely in the crosshairs under pressure, as are dollar-based assets, because the diversification benefits, and to your point around this fiscal issue that's continuing to develop from today to 2030 when Social Security could run out, these central banks are seeing the challenges. So while we might think it's risk and uncertainty and geopolitical, it's really being driven by diversification benefits that come from gold and replacing dollar-based assets.
Yeah, which is interesting, Robert, because even over the last year or two, de-dollarization, you wanted to be really careful how you framed that argument. Do you see the U.S. dollar losing reserve status?
So, no. Conversely, no. We do a fantastic job in the U.S. of spending way more than we actually make and sending our dollars to the 4 corners of the earth. So no, that's not in the immediate future. But we've also never been closer to it. And if you look back over time, what has happened to countries who had issued currencies that are used in the same way a global reserve currency has and then lost it, it's because they overextended either militarily or with their debt and deficit or both. And so that's clearly on the radar. And Joe's being a little humble with his data. We use his data as well as the industry standard. And the last 3 years, central banks have taken in as demand 1/4 of all the gold mined globally. And so we looked at why is that? And as an offshoot of the global financial crisis, gold was raised to a tier 1 asset. I know accounting speak, but it meant that anyone that holds gold can hold it at 100% of its market value rather than 50% of its market value, which existed before. So it was elevated to tier 1, so it could be used as a stabilizing asset in central banks. They no longer get that 50% haircut to hold it. And so you just saw demand starting to take off. Right. And gold demand in the central banks is a little like the Hotel California. It checks in, but it never checks out. And
we do have a few use cases where you can see it in action. I think we talked previously about when Turkey had a presidential election, which destabilized the lira, stepped in, sold gold, bought the lira, stabilized the currency, the balance of payments are in control. So you can see it in action. You can see it coming to the table. And again, to your point, it's been a record-setting year 22, near record 23, near record 24. Pace in 2025 first quarter a little off that 1,000+ ton rate, but it looks strong. And we're not hearing any signals that that case is going to slow down. And that's a really strong use case. And what's really interesting to watch is how investors are going to move now. And I think globally, what we're seeing is the US starting to realize we should be diversifying more than maybe we have in the past. And that's been part of what's contributed to this outpacing returns that we've had. We're frothy and people are kind of trying to call the price, but they're kind of backing off it a little bit and saying, we don't know, this could be a little bit too much for gold. And it's run up so much because people are moving quickly into the asset when they've been underinvested for the last 3-4 years. Right. Now we're looking at that space. We're watching global investors, including China, who have hit record levels with ETF flows in gold, and actually what's happening in India, what's happening in Asia, and then also just kind of where the US is going to land in terms of allocations for portfolios here on shore.
Yeah, what's interesting as well, Thomas, in addition to fiscal, monetary, and macro geopolitical demand, critical minerals overall, because of the energy transition story there, I mean, it's inherently going to create that demand, which is something fundamental. you're not kind of guessing what the Fed's going to do.
For sure, for sure. Look, I think while there might be some bumps along the way, the long-term trend and trajectory around the energy transition remains intact around the world. Interestingly, that creates demand, obviously, for those critical minerals. Those new critical minerals operations, some of them themselves will produce gold and silver as a byproduct. Similarly, miners that are in the gold and silver space are increasingly thinking about what critical minerals they may have as byproducts themselves to offer into those industries. And kind of interestingly, even if you step back and look at major copper and diversified miners, a number of those actually already produce gold and silver as byproduct in quite substantial quantities.
Joe, you had mentioned, stability as a big part of your talking points before. Is that why we're seeing interest, particularly this year, out of the administration as it relates to stablecoins and how we think about fiscal and monetary policy?
Well, I think the stablecoin market's probably the most interesting in what we'd probably broadly call the crypto space.
Right.
I think there's lots of talk and interest in Bitcoin, and the use cases are still very unclear for the market, but there's definitely interest. But stablecoins are different. They're a different breed. They're kind of a digital version of money market funds.
Right.
And that actually is a very interesting space because I think the US can see a world where if there's adoption of those instrument types, the rails are easier to access, quicker, more use cases developing on the back of that. That could be a very good way for dollar-based assets, stable asset baskets to fit into the picture. So I think it's different to what we're seeing with gold. I think gold's the diversifier away from that, and I think that trend will continue. We're seeing it, we know it, and people are worried about that, but I think this working together with a stablecoin kind of an environment might start to be something interesting to keep an eye on. I'd say watch the gold space now. I'd say watch the gold space from a central bank market, and let's see how investors really move to get the kind of diversification, because one dynamic with the bond market right now is correlations are tracking a lot more like you see with equities. And so when you talk about drawdown moments, and we've got a lot of data that supports this, the drawdowns are when you really see the power of gold. So if you're looking at a global financial crisis, a shock to the system, when things are going wrong, it's those moments, and that's what these central banks are telling us too. It's those moments when they know they need it. It's liquid and it holds its value.
Yeah. Robert, what about other industrial metals?
So we often get asked questions about the gold-silver ratio, and it drives me a little crazy because they're not substitutes for each other. No one sits and says, what's cheaper today, gold or silver, and I'll consume that. What it does do a really good job of doing is when the gold-silver ratio is very high, gold's a lot higher priced than silver. It has signaled an extreme pessimism in the global economy. And we looked at different points. March 18th of 2020, I think we all remember that day. It was the day after then President Trump announced a $1 trillion stimulus package that wound up multiples of that. But another was in 2008, and it was the day that the Lehman bonds were auctioned off for 8 cents on the dollar. And so, maximum pessimism. And so some of the reversion in that ratio comes from a little pullback in gold. Some of it comes from a takeoff in silver. But what has happened is industrial metals have really attracted a lot of attention after you pass that peak of maximum pessimism on the global economy. And people are pretty pessimistic on the global economy right now with all the tariffs flying around. So we think that's a very interesting trade. It gets to Thomas's point where you can't just throw money at a mine and get supply out.
Right. I mean, you could make that argument for any sector, right? It's like, let's talk about the tech sector for a moment. If you're trying to figure out, what is going to be the next technology, or just, invest in companies that have AI in their name, right? I mean, you have to be discerning no matter what.
Yeah, for sure. And often in mining, we tend to focus quite heavily on the geological side of things, the deposits, the difficulty of finding them, the scarcity, the difficulty of bringing them to market. But you're touching on a really important point, which is that talent is pretty quickly becoming one of the scarce commodities and inputs to all of this as well. The talent and demographic cliff has been spoken about for some time, but we're really starting to see that bite now as retirements kick in and as young people have got more options than ever before to go and do interesting things with their lives. And so as we think about the mining sector in particular, the ability to attract, to retain, to develop the best talent pretty quickly becomes a competitive advantage that we think will separate some of the winners and losers going forward.
Yeah, and that's why I was asking you about productivity and how it's enabled by AI, because
Absolutely.
again, if you have a comp sci degree as an example, you can work in any industry. So it sounds as if that's going to be the differentiator. Do you think the industry is doing enough for that kind of messaging to get fresh talent in there? Or how are companies going to address this? Is it through acquisition? Is it going to be organic?
There's definitely a lot of interesting startups that are out there, often led by young people, and so certainly acqui-hiring becomes an avenue. But to your point, look, young people have got many, many places and options to go, and I think part of the industry's role now is to really get out in front of that and show that it can be a viable destination, not just viable, an exciting destination to go tackle some of the biggest, most important questions and problems that humanity faces. This is a great place to be building a career, and there's a ton of opportunity to go after.
We get to work in some pretty cool places too.
Absolutely, absolutely.
We just to add to what we're talking to, the London Bullion Market Association, World Gold Council, and other organizations have all pushed forward with blockchain technology to track and trace gold. There are also some really interesting projects that we're looking at with other organizations around understanding what's at the rock face and how you can track that from the rock face to the processing units, from the processing units to the refiners or all the way through the supply chain into the end consumption side of things. But the tracking and tracing technology that's coming out is actually, really attracting a young group of people that are actually very talented and using modern technologies to move away from the old antiquated systems of spreadsheets and databases.
Well, I mean, especially, supply chain could be a double-edged sword because there's so many vulnerabilities that exist as well. Sure. So now you start looking at, other areas such as cybersecurity professionals and so forth. So that does, blockchain and kind of providing that transparency and so forth. Joe, we have a few minutes to go here and I want to get everyone's opinion. What needs to happen? What's the next catalyst? Is it tariff resolutions? Just what's the next big thing that has to happen either way for gold?
I think where we need to see us land, because I think at the heart of what's been driving gold up nearly 30% year to date has been this short-term, very risky, very challenging environment to figure out. Right. But behind it are still these fundamentals of the fiscal policy that the US in particular is facing, and other nations as well. So you still have a lot of problems that are at the heart of what's going on. I think we need to get through this wave of uncertainty and almost emotion, and then get us on a path of trying to get better back to understanding what monetary policy is going to look like, how the challenges of this fiscal policy is going to play out over the next 5 years, and work with fundamentals. I think so. I expect us to smooth out a little bit along this bumpy ride and ultimately come back to the slow expected growth of about 8% for gold on an annual basis. So I think we got to get through tariffs and trade.
So Robert, we have to pay off nearly $40 trillion to, for the rest of the downside there.
Well, so we're on the different side of the cryptocurrency and stablecoin argument, and I always appreciate the back and forth. But whether it is the government that prints the money, or whether it is every 11th grader in high school who issues a meme coin, it still is currency. It still devalues the price. It inflates the price of everything in the economy, and so we don't really see a pullback in that. Right. We just finished the largest effort to shrink the government in 20 years. And we got $9 trillion of savings. It's like 0.1% of the budget. So it's not really a success. And so it's very hard for the politicians to stop spending the money for very good reasons. There are demographic reasons, et cetera. Right. So we don't see a pullback in the near future for gold, for the central bank reasons, for the fact that most investors are still tremendously underallocated to gold when we look at the number of ounces they hold.
All right, last 30 seconds here, Thomas. Policy is hard, right? I mean, it takes a lot of work to get the budget balanced. So there's those tailwinds still provide some long-term opportunities.
No, definitely. Look, and I think from the mining and supply side, where we see the opportunity is on companies bringing new projects to market. So if you've got a project at the moment, what a great place to be. Cost discipline, capital discipline, they're then the critical factors for setting up, value creation in the next decade.
All right, appreciate everyone's insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.